Okay, I will post this recording on YouTube after the end of the webinar. Again, hopefully everybody's safe on this snowy day. Today, what we're going to do is we're going to talk about how to get multiples and do the multiple analysis for your group project and to get the data to do that from Bloomberg. So in this case, what I had done is under the files section, I uploaded under target, the data for target, the baseline file, and a very simple as is valuation. So that is the file that I'm going to use as an example for our webinar here this morning. So let me open that file. And just talking about target, I did the as-is valuation when their share price was 56 and change. So I came up with a share price of 57.35. It was relatively straightforward. Basically, looking at the IBIS World Report, saw retail is not growing at a very high rate. So for discount retailers, looking at their historical growth rates, I looked at Target as a relatively mature firm, slowing their growth to about 3%. And their margins, I ended up, because the share price was too low, assuming that they were going to improve their margins slightly over where they're going to be in the next 2 years, back to more of a historical norm of an operating income margin closer to 7%, which is where they were in 2010, and versus 5.5 or 6%, which is where the analysts are expecting them to be in the next 2 years. That got me to a share price of 57.35. So what I really want to focus on today, as we try and do a final valuation of target, is also the multiple analysis and how we're going to add the multiple analysis to our model. So I'm going to open up Bloomberg, and this is going to involve your next, what I'll call bonus homework assignment. So today, I'm going to give you, as I mentioned, time in the Bloomberg lab to work on an extra credit assignment, which will be due on Monday, relative to the multiples comps and updating the model. So I'm going to give you the steps necessary to complete the extra credit here in this webinar. So I'm going to open up Bloomberg and log in. And in this case, what we're going to do is for target, we had gotten the data out of target to do the valuation. The section that we're going to use to do multiples analysis on a company is the RV section, which stands for relative valuation. Again, relative valuation allows you in Bloomberg, so I can either type RV once I'm on the company or click on RV. But relative valuation allows you to quickly compare a series of peers across any number of financial ratios. So again, when we do multiples, we're going to use, just as we did in the EIC, the Bloomberg selected peers. So these are the Bloomberg selected peers for target. Obviously, if I'd like to edit this list, like let's say I wanted to get rid of Five Below or PriceSmart for some reason, I could click on the edit comparables. I could uncheck Five Below. I could save it, and that would then create a custom list. Or if I wanted to add a security, I could type in the security name or ticker symbol, and again, hit enter. It would add that to the list, save it, and again, create a custom list. But for the purposes of this exercise, I'm going to use the Bloomberg Standard Peers in the country of domicile, which basically means the US peers for target. So again, if I go to these tabs, you can see that there is, in, for example, the comp sheets, as they call them, they have under equity valuation as a sub-tab. They already have a series of multiples for the company. I could also click on profitability, and here's a series of profitability ratios again with the most current data across companies. For our purposes, we're going to use the custom tab, and under the custom tab, we can create our own series of custom templates. And you can see that I have a series of custom templates already saved here, and we are going to create our own template for this class for our multiples. So basically, as I mentioned, there are 6 multiples that we're going to care about in this class. The first one, or the first 3, are the enterprise value ratios, EV to sales, which again tells us how much value, enterprise value, we're creating for every unit of sales. So what I'm going to do is under add column, I'm going to add the multiple I'm looking for. So I'm going to start typing in EV for enterprise value, and you'll notice it'll tell me what fields exist in the Bloomberg database. 2, and then you see there's different choices there, and I'm going to add in enterprise value to sales. And you'll notice that there are 2 enterprise value to sales ratio, EV to this year's estimated sales, EV to next year's estimated sales. So the convention that we'll use is forward year 1, which would be the upcoming fiscal year. So for Target, that would be their 2014 year. EV2, EV forward year 2, next year's sales, would be essentially 2015. So in this case, we're going to want forward year 1, forward year 2 as part of our multiples. So forward year 1, EV to this year's estimated sales, hit enter, or select it with your mouse, hit enter, and you'll see that the EV to sales is here. Now, BE will stand for best in Bloomberg, and best means Bloomberg estimates. So Bloomberg is consolidating the analyst guesses, right? So I'm going to do the same thing with next year. So I'll type EV to sales, and I have EV to next year's sales. So based on the upcoming uncompleted current year, Target has an enterprise value to sales of 66 cents. EV to sales based on next year's estimated sales are 64 cents, right? The next enterprise value multiple is EBITDA. So again, the same thing, EV to EBITDA. And you'll see that there's an EV to best EBITDA. Click on more matches here. And one of the other nice features of Bloomberg is if I ever click on, once I click on more, click on a ratio, it'll actually tell me what the description and what the calculation is. And I can also change the period. But in this case, if I chose EV to the best Bloomberg estimated EBITDA, I could actually go down here and choose whatever range I wanted as a period. But as I said, for Bloomberg, because these ratios are pretty popularly used by analysts, they've already created 2 of them. So again, same convention, EV to this year's estimated EBITDA. Let me go ahead and select that. And then I'm going to do same thing, EV to EBITDA for next year. Hit enter. Next, EV to EBIT, which is enterprise value to operating income. So, you want to type across the top of the screen, you'll lose everything. EV to EBIT. Show more matches. So you'll see I have a down here, EV to this year's estimated EBIT. Select that. EV to EBIT. Which is EV to next year's estimated EBIT. Okay, so I now have my 3 enterprise value ratios for the next 2 forward years. Next, I'm going to add in the price to earnings ratio. So P/E, price to earnings ratio. And again, I have the best PE, so the Bloomberg estimated PE for the current year, which, because that's an estimate, that's the forward year one PE. And then again, if I type in PE, I have the estimated PE for next year. So this would be based on the expected 2014 PE for Target at this time and the expected 2015 based on forward analyst estimates today of their price to earnings ratio. Next, I'm going to add the PEG ratio, and there is only one PEG ratio, and in this case, the best PEG ratio. And the PEG ratio, remember, is the 5-year estimate of earnings growth rate. So again, that best, even though it's the current year, is the current year's expectation of the 5-year growth rate, right? Based on the current PE ratio, right? So given the current year's PE ratio divided by the 5 years ratio, that would be the best PEG ratio. Now, again, if I went back to PEG and I chose the best PEG ratio for next year, that would be the PE next year, or in this case, the 2015 PE divided by the 5-year earnings growth rate. So for our purposes, we're just going to use one PEG ratio, which is the current forward year's PE divided by the earnings per share, and that is this PEG ratio, right? The final of our 6 ratios is price to book. So I can either type in P/B or type in price to book, and there is my price to book ratio. And again, I'm going to do it based on the current price to book, which will be based on the latest close. Okay. All right, so I have my price to book ratio. I have my PEG ratio. I have my PE ratios, because again, current stock price divided by current book value. The price to book ratio on latest close. The one piece of information that we're going to try and do with all of this is we're going to try and estimate ROICs. So the final piece of data that we're going to need is the growth rate. So in Bloomberg, the growth rate is kind of built into the PEG ratio. So what we're going to type is the long-term growth rate in earnings per share of a company to proxy out our growth in cash flow. Again, it's going to give us more directionality than an absolute level of G in our models. But again, I type in LTG, and that will get us the Bloomberg estimate, long-term growth rate, earnings per share. So in this case, if I click on that and I will take my long-term growth rate and earnings per share, the current one, based on whatever's current in the database. That is the long-term growth rate estimate of earnings per share of these companies. And you can see that some companies have higher estimates of earnings per share than others, right? So the final step is I'm going to want to, instead of creating this template, I'm going to want to save this template. So I'm going to click on Save As, and I'm going to name this template. So let's call this my comps or multiples, if that is easier, multiples template. I'll hit Save. Now, I had already had one that I had saved, so I'm going to hit OK to overwrite it. Or what I could do is, if I didn't want to overwrite it, if I change comps, so let me call this 760 comps, one for this class, hit save, overwrite, I had that one too, so hit OK. In any event, when I save it, it will add a tab to this so I can quickly go back here and see this template anytime I open up across a company. All of these will be here and available to me. And let's say that I really didn't need the market cap on my template. I can right click on any of these fields. It'll give me some data. And one of the things I can do is I can delete the column. So if I want to get rid of something from my template, and there's this little gear icon over here, which will allow me to later, if I want to modify my template, add a column add a custom formula. So I can actually create my own custom formulas within Bloomberg and save them. Or I can save the template and essentially it'll overwrite whatever was there. So final nice feature of Bloomberg is, let's say I'm trying to figure out enterprise value to EBITDA for the upcoming year and I want to visualize the data. The other option I can do is I can right click, I can click on graph column, and it will very quickly give me a graph of the enterprise value to EBITDA multiples. So again, picture's worth 1,000 words. I can see a picture, and when we talked about doing a market cap weighted average, I can add the market cap weighted average line. So the current market cap weighted average and EV to EBITDA for the industry is this red dashed line, and I can see Target is trading at a discount. And if I wanted to the graph, I can add securities, subtract securities, etc., and quickly change the graph. By the way, they also give me the option to do what's called a histogram. So again, I can see kind of what the trend is in the industry against the different peers in the industry based on a normalized bell curve. All right, so let me go back just so I can show you that if I go back to RV and I went back to my Bloomberg peers and I went back to custom and I clicked on my 760 comp template, then there is my save template. Again, advantage of saved. So what I'm going to need to do is select stats and do a market cap weighted average. So now I have the average, same as what I just showed you on the graph, the average market cap weighted average for each one of these multiples. So there's the industry defined by these firms is trading in an EV to sales this coming year at 0.66, EV to sales next year 0.62, EV to EBITDA 855, EV to EBITDA for next year 7.96, etc. Industry's long-term growth rate 10.36% earnings per share. And remember, this is earnings per share, not cash flow, so it doesn't translate to the exact G we're using in our model. But again, it gives me a sense of directionality. Obviously, these companies are growing down here, Five Below, PriceSmart, Dollar Tree, much faster than the industry average, where Walmart is expected to grow lower than the industry average. So we're using it more as a proxy, and Target is very close to an industry average growth rate. All right, so analysis. One of the analysis that we're going to do is try and figure out what the expected ROIC is and why a company is trading at a premium or discount. So again, if we go back to our concept of multiples, one of the key facts of what drives multiples is assuming similar cost of capital, then it's really ROIC and growth have the biggest differentiator in multiples. Again, assuming similar tax rates, assuming similar capital structures, assuming similar non-operating items. So again, start out with that premise and see if we can make sense out of these multiples. So in this case, Target, if we look at EV2 Sales, and they're trading very close to the industry average. But if I look at EV to EBITDA, they're trading at a discount to industry average. And if I look at EV to EBIT, they're trading at a discount to industry average. If I look at their PE, they're trading a little bit discount to industry average. And they don't really have a PEG ratio calculated. Sometimes it's not available. Sometimes it's because there's a negative number in there. With a negative PEG, they don't show it. They'll just show it as not available. And they're trading at a price to book of 2. But here's the thing. Their growth rate is slightly above industry average, but very close. So here's what I can discern from the data. For a very similar to industry average growth rate, even though it's slightly above, and their enterprise value multiples to EBITDA, EBIT, and PE below the industry, it appears that Target probably has a lower ROIC expected than the industry average. And that's really what I want to start to understand, is that Target is probably going to generate less ROIC going forward than its peers. What's interesting is the EV to sales are about the same as the industry average. So what it really suggests is Target probably has similar margins to the other discount retailers. They're probably just less efficient right now, and therefore they're not getting as much out of their sales. And that's also why they're trading at a slight price to book discount. So again, that's what I can infer on Target. Now let's look at Costco, who we had talked about earlier. Costco is growing faster than the industry average. Now, Costco has one of the lowest EV to sales in the industry. Actually, it looks like it's the lowest, which suggests actually, Big Lots is lowest, but suggests a lower margin firm than Costco. Because again, EV to sales is indicative of margin. How much value do I get when I sell an incremental unit of sales? Typically, firms with higher margins are going to generate more cash flow for every dollar of sales. So in this case, lower margin, but here's the thing. They're getting a very big premium on their multiples to EBITDA. They're trading at 11 times and 10 times the next 2 years versus about 8.5 and 8 times the industry. They're trading at a big premium on EV to next year's EBIT, and their PE is the highest of these major peers, and their PEG ratio is very high. Their price to book is high, and as I said, their growth rate is a little bit higher than the rest of the industry. So here's what I could assume about Costco. Remember that growth and ROIC, particularly a positive spread, can be multiplicative. And I think that's what you're seeing here with Costco. I can say that Costco is getting more premium in multiples because not only are they growing faster than the average, but they're growing faster, and particularly with this very high PEG ratio compared to their peers and the industry average, they're growing at a very high ROIC, and those two together are causing them to trade at a much bigger premium relative to the peers of the industry. Right? So I can get a sense of that. Right? Now, here's the other company in the industry that we could talk about, which is Walmart. What is Walmart doing here? Well, Walmart, which has a growth rate a little bit below the industry average, has a PEG a little bit below the average. Their EV to sales is a little bit below the average, which would be expected because they probably have slightly lower margins. EV to EBITDA, again, below the average, though slightly above target. The EV to sales, EV to EBIT is below average and about the same as target. PE, again, a little bit below average for both years relative to the industry. So again, consistently trading at a discount, and a PEG ratio slightly below average, and a price to book slightly below the industry average. So again, here's what I confer about Walmart. They probably have a positive spread, because again, they have a positive price to book. But the challenge with Walmart is they are growing among the slowest in this industry in earnings. So they're probably not expected to have as much growth. And given a slightly lower PEG and the fact that their multiples are below most of their peers, even including Target, particularly on EV to sales, it suggests that Walmart probably has a slightly below average ROIC and slightly below average growth rate relative to its peers, which is probably why it's trading at a discount. So that's really what we're trying to discern. Now, one thing we could do is we could pull up the key value drivers formula for these firms. We could start putting in some assumptions, and we could test this a little bit more to see what kind of multiples we would create. But nonetheless, this gives me a sense of the type of analysis. So I'd almost want to rank the firms in terms of expected ROIC. And of the three firms, Costco, Walmart, Target, I would probably rank Costco as the highest ROIC. And of the three, if I wanted to think about who has probably the lowest expected ROIC, I would probably say Target. And because again, higher growth than Walmart and a little bit lower enterprise value multiples and PE multiples than Walmart. So I'd probably rank them Costco, Walmart, Target in terms of expected ROIC. So that's really the sense of what I'm trying to get to at the industry. Now, again, this industry probably does have a slightly positive spread. Again, higher PEG ratios and price to book values. And that's kind of the analysis I'd like you to do with multiples for the industry that I give you and your industry for your group project. So if I want to save this, I have two options. One is I could save the screen, and I could call this target-RV. And the other part that I'm going to need to do is I can also output this data to Excel. So I click on Output, I click on Excel. Downloads the file, and it will dump it into Excel. So just as when we exported data from the FA screen, we got the security warning, we're going to get a similar security warning anytime we dump to Excel. We'll say yes. And what it's going to do is it's going to basically give me all of this data into an Excel template. Now remember, just like we had the FA screen, these are database lookups. These aren't actual numbers. So if I want to leave the Bloomberg lab, select copy, paste special values. So now I have numbers. And for my NAs, again, search for Control F, my pound n/a space n/a, and replace those with zeros. So I got rid of my NAs, and my own benefit, because there's lots of numbers here, I'm going to make all of this formatted to 2 decimal places, just so it's easier to see the data and be able to interpret it when I leave the lab. So I'm going to File, Save As, an Excel workbook, my Downloads folder. I'm going to call this my Target Comps for comparables. All right, so I now have the data file that I've saved in Excel from the lab, and I also have a screenshot. So I'm going to go back to my target valuation model. And the next step that we're going to go through here is I'm going to take the multiple spreadsheet and I'm going to add it to my valuation model. So specifically, the easy way to do this is I have my target as is model open, and I'm going to take the Bloomberg file that I just created in my downloads folder here. And for purposes of this, I'm going to move this to the same folder I have with all the other target data. So right now, if I go back to Canvas, I'm going to take these 2 files and I'm adding them to Canvas. So they're there right now. Anybody's trying to follow along with what I'm doing. So the comps is, as you will see in just a second when I open it, that is this comps GIF file is the screenshot. The XLS file of the comps is the Excel spreadsheet that we just created. Okay? So we go back here. Where was that file? Must have closed. Anyways, EMD, back to target. All right, so here is the Excel file that we just created that I've reopened. Again, has everything to 2 decimal places with the forward data for target. And what I'm going to do is I have also opened my valuation model in Excel. So I'm going to go to the comps model. I'm going to go to sheet 1, which I'm going to relabel my multiples. And I'm going to right click on it. And then I'm going to choose move or copy. And what I'm going to do is I'm going to copy to the workbook the valuation model for target. And I'm going to put this tab into that model at the end. So by moving it to this workbook at the end, okay, then what I've just done is I've taken that file, that tab in that file, and I've moved it as the last tab in my target as is valuation file. Okay. So, one, why did I do that? Well, it helps me as I'm valuing the company to see this data, and this is part of my group project. But 2, it also gets to a reality check on my valuation. So there are going to be 2 reality checks that I'm going to require us to do when we do our as-is and final valuations, because even though we're predicting the future, we're using historical data and our assumptions to predict the future. So we have to be able to test it in some way. So one way that we're going to test our valuations is we're going to use what we call the multiples as a way of testing the valuation. And here's what I mean by this. I'll make it a little bit bigger so it's easier to see. So these are the multiples for Target and its peers and the market cap weighted average based on actual data. Well, in our valuation, we are calculating a value of the company, an equity value. We're also calculating an enterprise value. We're also forecasting sales. We're forecasting EBITDA. We're forecasting EBIT, operating income. Like I said, we're forecasting net income. So therefore, we're essentially forecasting in our model an enterprise value to sales. We're forecasting in our model an enterprise value to EBIT and an EBITDA and a price to earnings ratio and a price to book ratio. So that's what we're about to do. What I want to do is see what forecasted share price I'm coming up with and what that implies about the multiples. And this is what I'll call the implied multiples or the implied comps valuation. And then I want to test the multiples that I'm getting in my model against the real world multiples and the range of multiples that people are actually willing to pay for those assets. So that will be one of my valuation reality checks of a company. So for example, if Costco were, through my model, to trade at an EV to EBITDA based on a strong buy recommendation close to 11 for next year or 10, then they would have to be doing as well as a company like a Costco. Very high growth rate, very high levels of ROIC. And so, as a reasonableness test, I'd have to go back and look at my assumptions to say, is that reasonable that they could do as well as Costco? But here's the other thing. Let's say I put Target in a buy mode and I get in a frenzy of changing my assumptions. And the next thing you know, I have an EV to EBITDA of 13. Well, I start looking at the range in this industry and I realize, except for a couple of very small firms, that's just not a reasonable range that anybody's paying for this industry, which means that the analysts that actually cover this industry professionally are not seeing the institutional investors paying that level of growth and expected ROIC for these firms, which means I probably have an unreasonable valuation. So again, I can look at the range of these multiples and I can look at the pure type companies for how I've assessed their expected ROIC and growth to help me test and infer whether or not my buy, sell, hold recommendation makes sense and how it compares with some of the data that is out there in the real world based on my assumptions creating a multiple and how I'm doing against that range. So how do I do that? Well, there is one adjustment that we're going to have to make to our model, and that is that the way that we calculate enterprise value currently in this class is different than the way enterprise value is calculated in the real world, and we're going to have to adjust the two. So if you remember our calculation of enterprise value, it is the operating value, all the ones, plus the non-operating values, the twos, equals EV, and that is what pays the debt equivalents and the whatever's left, the equity equivalents, the threes and fours. Well, here is, back to Bloomberg, here is the data on Target, and I'm going to go back to the FA section, financial analysis section of Target, and on the very first part of financial analysis, the first tab is key stats. And under key stats, they calculate an enterprise value. In fact, they also have a detailed enterprise value tab. In either case, click on enterprise value, or if I look on highlights, I'll see how Bloomberg calculates enterprise value. What they do is they take the market value of equity, what they call the market capitalization, that is this value, the common equity value, and then what they do is they add in the minority interest, they add in the preferred stock, and they add in the debt. So again, if you go back to our definition, they're taking the equity value, they're adding in the preferred stock, the minority interest, and essentially the debt. Right? And then what they're doing is they're subtracting the cash. And that is how they are defining enterprise value. Well, if you think about it sort of conceptually, what they're really doing is they're taking the 4s plus the 3s, and if you look at the 2s, typically for most companies, the biggest 2s are the cash that they have. So they're kind of subtracting a proxy for the 2s. And what you're left with, if you take 4 plus 3 minus 2, is the 1s. You're left with a proxy for operating value. So if you want to look at sort of an apple and an orange, the comparison between what we're doing in our model and what they're doing in the real world is that the real world enterprise value is proxying what we in the model would call the operating value of the firm, right? But again, language, it's the enterprise value that's being calculated. So again, why did they use these shortcuts in the real world? Because when the real world models were developed in the 70s and 80s, so again, I went to business school in the 80s. My professors at Wharton came from Chicago. So it all goes back to Chicago. And when they were developing all these cash flow models, accounting was a much simpler time. And back then, you didn't have a lot of joint ventures. You didn't see a lot of excess cash. You didn't see a lot of other non-operating assets. Companies had usually pretty straightforward balance sheets and income statements. So simply, they also didn't have a lot of the exotic derivatives for financing. They didn't lease a lot. They just did more plain vanilla financing of debt and equity. So the original models, the original definition of enterprise value that's in the textbooks, like Braley and Myers and Ross and Westerfield, were basically created by the people that used more simple formulas. And it was debt and equity minus cash as the biggest non-operating asset equals operating value. And that's what's being adopted as a convention in the real world it stands today. So what I have to do here is I have to adjust the model so that the multiples that I'm creating in the model match the multiples that are being created in the real world so I can make an apples and apples comparison if I'm going to do that valuation test. So here's what I'm going to do. On my DCF tab, I could also do this on my EP tab. I'm going to have next to my enterprise value, I'm going to call this the Bloomberg equivalent. Bloomberg EV. So this is the way Bloomberg would calculate the enterprise value. So what would they do? They would take equals the equity value plus they would take any minority interest, plus they would take any preferred, plus they would take any debt. And then what would they do? They would subtract not the excess cash, they actually subtract all of the cash, concept of net debt. And again, in the real world, people don't differentiate between operating and excess cash. They should, they don't. So here's the thing. If I go back to my balance sheet, then I have all of my cash balance as operating and excess. Or I can go back here on the data tab and I can see that I have my cash and near cash items as cash, right? As well as short-term investments, which would be marketable securities. So basically, what I want to do is subtract for the most current year, and I'll do this off the balance sheet tab, is I'd subtract off the cash and the short-term investments, the marketable securities, which is the way they would do cash, and hit enter. And that would actually be what I would call the Bloomberg equivalent enterprise value using the way that they calculate it. So I'm going to go back to my multiples tab, and for target, I'm going to insert a row. And what I'm going to say is I'm going to call this my model or target or we're going to use this for different companies. So model multiples, or use model implied multiples, because these models are, or these multiples are implied based on what I've calculated. So the first multiple was enterprise value to forward sales 1. So equals what I'm calculating in the model for enterprise value divided by, from the income tab, forward sales 1, would be 2014. Equals, again, the Bloomberg equivalent enterprise value divided by, from my model, income tab, forward sales to 2015 revenue. All right, next, I'm going to do I want to make sure I just didn't overwrite something. Did I overwrite something? Yes, I did. Hit undo. Put in the wrong cell. So equals, I want to overwrite the market cap weighted average. So again, my enterprise value divided by income forward sales to 2015. All right, next. EV to EBITDA equals enterprise value divided by income 2014 EBITDA, which is row 7. So right there, H7 equals enterprise value divided by ratios, sorry, income 2015 row 7 EBITDA, enterprise value to EBIT equals divided by ratio income, go to the ratios tab, 2014 operating income, which is row 9. So H9 and enterprise value to next year's EBIT, Bloomberg enterprise value equivalent divided by 2015 row 9. PE ratio. This is easier. Equals next year's PE. So price per share. Well, here's the thing. What I really have is on my DCF, price per share divided by earnings per share, take out shares. What really is it? It's the equity value, the price, divided by the earnings. In this case, go back to the income tab, 2014 earnings, net income. Actually, take that back. Let's do earnings available to common shareholders equals EP valuation, sorry, DCF valuation, equity value divided by income 2014, here it is, normalized income after any gains or losses, something they do in the future. All right, equals for next year, same concept, equity value divided by income 2015 normalized income. All right, PEG ratio. We don't really have a long-term growth rate of earnings per share in the model that we're forecasting, so therefore we're not going to have a model PEG. And finally, a price to book ratio. So we're not going to have a long-term growth rate here. So a price to book ratio equals, again, price per share, DCF valuation, common equity value divided by balance sheet, 2013 book value of equity. Now, here's the thing. The book value of equity is the common. So really, it's divided by the share capital, which is 31, plus the retained earnings, which is 32. So for order of operations, I'll put a parentheses around that. So it's price divided by book value of equity, which is those two combined. And there's my expected price to book. So again, If I wanted to put the market cap in here and compare it, I could also do that on this page. But really, what I have here, and I'll do the implied multiples, and I'll make them bold just to stand out a little bit. But here's the idea. This is what I'm implying. Now, remember, my share price doesn't match the exact share price of Target at the time. I'm relatively close, but based on a share price of 57.35. And when I did this, Target was at, I think they're 56 something. So again, I was trying to be within $1 at the time, but back to this, that's why it's slightly different. But here's really the point. Let's say I go to my ratios, now that I have my model. And I'm going to resave the as-is valuation here. So save as is, with comps. So I'll upload this file for you. But basically, let's say that I just came in and, I don't know, I went crazy and I decided they're going to grow at 10% a year. And now they have a $93 share price. Well, notice what's going to happen to my implied multiples. That means an EV to sales of 1. And clearly, none of the big players in the industry are near an EV to sales of 1. Second, it means an EV to EBITDA that is much, much higher than even Costco. Uh, Again, EV to EBITDA, these now look completely out of line. So as I said, it gives me sort of another way to test my model's assumption versus what's happening in the real world to see if I'm coming up with what I would perceive to be a more realistic valuation, which obviously I'm not, but that's one test. So let me talk to you about test number 2. Test number 2 is going to be a graph that we're going to add to our model. And in this case, I'm going to undo this kind of craziness that I put in. And the graph is going to be what we call the ROIC tree, or sorry, we have the ROIC drivers, which is the ROIC tree. We're going to add another tab here called the ROIC chart. Right? So based on beginning of year economic profit, just to be consistent with what we've been doing all year, this is the economic profit calculation. Now you'll notice that I also have in the model an end of year economic profit. And these ROICs after goodwill, which is the ROIC that matter, matches the ROIC in the ROIC tree because we're doing it based on end of year data. So we've already done an end of year ROIC tree analysis. So here's what I'm going to do. From the EOY tab, I'm going to take this row, which is the ROIC after goodwill. Again, final ROIC is always after goodwill. And I'm going to select the numbers and I'm going to create a line chart. So I'm going to insert either a chart, or in the Mac and Windows versions are slightly different. You can insert a sheet in a Mac. In Windows, you can only insert a chart. But in this case, insert a line chart. This is a chart sheet. You can also theoretically do a bar chart, but I'm going to do a line chart. But what I've done is I've kind of graphed the expected ROIC and the historical ROIC. And what I'm going to then do is I'm going to select my data, and I'm just going to change the X labels to be the years so I can see my scale here. But I pretty much have a chart of ROIC. So again, I'll call this my ROIC chart. And if I select data, I could theoretically name this chart ROIC. So this is sanity check number 2 to my valuation. What I really want to look at is in the out years, what am I expecting the ROIC, and can I defend reasonably with my assumptions this chart? So what this really says is that to get the valuation that Target is at today, which is somewhere in the mid-50s per share, that was $57 a share, which is the as-is valuation, that basically Target is going to earn somewhere around a 9% average ROIC, which is in the range of what they've done historically. Now, I know that ROICs tend to trend towards the cost of capital, but what I really don't want to see is what I call a hockey stick, where the ROIC is just trending up and up and up and up into the out years, because that tends to be less realistic, particularly for most companies. So to me, this ROIC chart looks relatively reasonable and seems like a reasonable valuation if I were to assume that Target is fairly priced and a hold recommendation. Watch what happens if I go back to my 10% growth rate in the out years. I'll go back to my ROIC chart. Actually, the ROIC is not changing. So let me go back to ratios. Let's do it this way, because I'm growing the balance sheet with the same. So I increase my margins dramatically. So this goes to 63%. Equals 63%. So now I have a $116 share price for Target. I'm very bullish because suddenly they're going to increase their margins to 13%, which is much higher than they've ever had historically. Notice what happens to my ROIC chart. Now suddenly they're earning 13% ROIC into infinity, where before they haven't, and this is what is called a hockey stick, and those rarely occur. So what I'm really saying is the future is far better than ever is the past for a company that's maturing and doesn't really have the growth prospects in a much more competitive market. This one doesn't seem nearly as reasonable. And again, go back to my multiples, the implied multiples also against the peers are not going to look very reasonable. So that's the two sanity tests that we're going to use against our valuation. And that's going to be part of the valuation presentation you're going to do next Wednesday. So when you do your presentations for section 4, which is the valuation, and I put up, so let me go back to Canvas. I put up as an announcement after Monday's class what is required for the PowerPoint and for the paper. There are 4 sections, and what I'm going to be looking for when I grade each one of the sections, both in the PowerPoint and in the paper. So let's talk about section 1. Section 1, you're going to have to do an EIC analysis. So it's going to be very important that you show me the data to support your conclusions. So you got to show me some screenshots. So specifically for section 1, for the economy, you're going to need a screenshot of what's happening with the economy. So you're going to have to go to the conference board and you're going to have to get the data from the conference board. So specifically, if I go to conference, spell it right, conferenceboard.org, I'm going to want to get the LE to I data. So I go here to the US indicators. I then go here to the leading economic index. And then I go to the most recent press release from February 20th. And this is the most recent LEI for the conference board. This is the most recent CEI for the conference board. So again, I still see an uptick in the LEI, which suggests the economy is growing stronger. Each of you should have a reference to this graph. Right? That was on the conference board website. Again, US indicators, LEI, press release. Second, going back to our PowerPoint. Second, you're going to have a 5-year beta. So again, in addition to the LEI and CI screenshot, you have to have a 5-year beta from Bloomberg's because you have to talk about the impact. Second, you're going to have the industry table. So you have to have the 5 forces table with the future and then a write-up of the forces, both current and the future, and why it changed. And very importantly, you're going to have the supporting RV screenshot with the industry-weighted ROIC and WACC that basically talks about why it's an attractive industry. So you're referring back to the RV screen. And same thing for the C, competitive advantage. You got to talk about the RV screen in terms of competitive advantage. So again, the RV screenshot is going to be very important. And your section 2, historical analysis, you're going to have to go through the ROIC tree. You're going to have to go through the 5-year CFI. Well, I need to see the ROIC tree and the CFI. So both those need to be your presentation. Both those need to be called out in your papers that you turn in the following Monday. Multiples. Basically, I need the same table for the multiples for at least 6 companies. right? So you need to have at least 6 multiples. You can have more than 6, but you have to have at least 6, your company plus 5 peers in your industry, plus the weighted average. And you got to talk about the expected ROIC. Again, if you have 15 companies in your Bloomberg peers, you don't have to do all 15. You got to do kind of think of it as like the big 6. But I want you to focus on the biggest 6 players that are compared to your peers. So if you eliminate everybody but the big 6, that's fine. Or if you leave everybody in, focus on the big 6. But talk about for the biggest 6 peers, your company plus 5 of the biggest ones. Give me a relative ranking of ROICs. Tell me why they're trading at premium or discount to the industry average, and particularly focus on why your company's trading at a premium or a discount. But again, you got to either show me, let's go back to this, you have to show me this screenshot, or you're going to have to give me the Excel export and put that in to your PowerPoint. Again, you got to refer back to actual data, show me you did your analysis and why you're making those conclusions, right? Next section, valuation. You're basically going to have 2 valuations. You're going to do an as-is, and then you're going to do a final. In the as-is valuation, you're going to show me, and this is what's important, the assumptions that you really focused on changing. So again, we said we're focusing primarily on changing growth rate and margin, and to some degree tax rate, but it's really growth rate and margin. Why did you make the changes that you did? What were the assumptions that led you to make those changes that got you to the as-is valuation? So essentially, here's the assumptions. Here's my explanation for why I changed them. For the final valuation, here's my change in assumptions. These are the assumptions that I changed, if any. And this is why I changed them. This then led to the final share price. Compare that share price against the current share price of the company. Buy, sell, hold. Within 10%, hold. More than 10% buy, less than 10% sell. Then you need to defend your final valuation. To defend it, you need to include 2 things. One, the ROIC chart. You must include a screenshot of your ROIC chart. And you got to make sure that that is defensible and explainable. So what you don't want to have is you don't want to have, back to the ROIC chart we just added here, you don't want to have this that you can't explain. So that's going to be important. And then finally, you need to put in the multiples. You got to put in the implied multiples. And again, same thing. You got to show me why these implied multiples make sense. And you got to basically defend the implied multiples relative to the industry. Now, what might be easier for you is if you use this screen in your PowerPoint and in your paper, you could use the implied multiples and these multiples mixed, one screenshot for both sections. Meaning in the multiple section of, let's go back here, in the multiple section of your PowerPoint and paper, you don't have to talk about, and specifically you aren't talking about the implied multiples. The implied multiples only are relevant to evaluation because the multiples are the multiples based on the current stock price. The implied multiples are only relevant to when you change the stock price from the current stock price and you're making a recommendation and what multiples they imply. Now, again, you could leave the implied multiples in the same screenshot and talk about the multiples and ignore implied multiples in the multiple section. But in the valuation, you must come back to that and talk about the implied multiples against the industry average, against what your valuation is to justify the valuation. So that's what's going to be key for next Wednesday. All right. So to help you practice, I'm going to give you the rest of the class time to go to the Bloomberg lab and essentially to create a Bloomberg template to get the data, to put it in the model, and to practice another evaluation using multiples, right? So, and you're going to use multiples to help you do that, right? So the company that I'm going to ask you to do is we're going to switch to discount retail, from discount retailers to retailers. And the company that I'm going to ask you to analyze is a company called, what we'll do, let's do Macy's, right? MACYS. They are department store chain. So again, MACYS. Ticker symbol is M, US equity. So again, here are their multiples. Here are their peers, Bloomberg peers. Here are the multiple spreadsheet already done for the Bloomberg peers. Just making sure that there's data there and it's not giving us anything crazy. So you're going to come up with something that looks a lot like this, right? And essentially you're going to compare Macy's and some of the other clothing department general retail stores against Macy's. You're going to do an as-is valuation of Macy's. You're going to do a final valuation of Macy's. You're going to do a multiples analysis of Macy's, and you're going to do the implied comp on your valuation of Macy's. So this is an extra credit assignment. It is going to be worth 2 points to your semester grade. So those 2 points could help you if you lost points on any of the graded assignments, and it is due on Monday. I'm less concerned about the extra credit and more concerned about practicing out sort of the final valuation using the multiples approach and talking through the multiples. On Monday, we're going to have a normal class in College Park, and as part of our class on Monday, we are going to talk through the multiples of Macy's, and I'm going to put a version of the target file that I just created up there, and I'm going to post a copy of this webinar video. So again, if you have any trouble with the step-by-steps, you can refer the video to YouTube. Hopefully that'll be there in the next 20 minutes. So you have 2 choices for working in the lab. Choice number 1 is you can go to down the hall of College Park. I think it's 1517 is the normal Bloomberg lab. The other lab is 3505. I have undergrads. The normal sections start at 11 a.m. today and go through 4:45. But the 3505 lab is going to be vacant because today's class for the undergrads is also a webinar. So there are an additional 25 or 30 Bloomberg terminals in that lab, in addition to the lab down the hall. So between those 2 labs, 3505, Van Munching, or the one down the hall, you should be able to go and get the data. And again, your company for analysis is Bloomberg. It's an individual assignment. Again, I'll post the specific details on Canvas in just a few minutes. And again, I'll upload this file to YouTube. Good luck. We'll see everybody on Monday. This will conclude our webinar for today. And again, I'm going to stop the recording and post this file to YouTube.